Hello, everyone. Thanks for joining us today. My name is Alejandro Garza Salazar. I'm Aztlan's founder and chief investment officer. Today, we're going to present the monthly market view for the month of October 2024. We shared the materials earlier this month, a little over 2 weeks ago. And so what we tried to do with this report is put together all the more macro variables that are part of our decision-making process and our analysis for stock selection across our portfolios. So what we're going to do today is I'm going to present all these macro variables and how they impact the environment in which we're evaluating our investments and how we're managing our portfolios. So without further ado, let's dive right into the document. First, the important information that you need to review. Please take a minute to review the information that is described in those two slides. And going right into slide number 4, it is important for us to present this slide at first every month, and we show this to our clients as well, and we show this in our investment committee to remind ourselves that the nature of markets is cyclical. We will always have bear markets every 5 years or so, and so this is exactly what this shows us. It's just to keep that in perspective. On average, 29.4% correction in a bear market. On average, the duration has been 298 days. We're out of that last bear market for the S&P and for Nasdaq. We're still a few percentage points away for the small caps. The small cap asset class in general has underperformed across the board, but it's still showing this recovery trend now lasting more than 745 days. So that's what we're showing here, just to keep in mind. The market is cyclical. No one can predict the market, the cycles, when we'll have a bear market. So it's super important to stay invested. Next slide. What we talk about here, what we see here is valuations and what are the drivers of valuations. So we're looking at the S&P 500. On the left-hand side chart, we're seeing the price performance for the S&P 500 over the last 20 years. That's the gray line. For valuation, we're showing past 12 months and forward 12 months price to earnings ratio. So how expensive, how cheap is the market? So what we see here, based on the historical 20-year time period, and by the way, the central dotted red line is the historical average, and the other two dotted red lines are the one standard deviations above and below the average. So by that measure, the market is clearly expensive. It is expensive both on a trailing basis and on a forward-looking basis. As we can see here, the forward P is 21.6 times for the S&P 500, and the upper bound one standard deviation above average is 18.8. So it is expensive. However, on the right-hand side, and we will review more of the fundamentals through the slides today. In this case, what we're seeing is earnings growth. So what we're seeing is also in terms of earnings growth, how corporate earnings are performing for the S&P 500. We're seeing 13.9% earnings growth forward, which is higher than the historical average of 11.1%. So this is one of the key takeaways, is that yes, the market is expensive in the US for the large caps, for the S&P 500. Yes, it is expensive, but fundamentals are strong. We're seeing higher growth. We're also seeing, and we'll see this in a few more slides, higher return on equity. So companies are becoming a lot more profitable, a lot more efficient in capital allocation. So those fundamental factors could be driving valuations higher. And so it's, in our view, not as easy as in previous cycles to assess whether the market is really that expensive. We see some fundamental merits to the valuations that we're seeing in markets. Basically, that's what we're seeing. Next slide. What we're trying to do is we want to strip away the magnificent seven, the Max 7, for sure. We know the mega caps have performed exceedingly well. That's exactly what we're seeing on the left-hand side chart. The gray line is the Max 7, and their performance is since January 2020. The red line is the S&P 500, and then the S&P 500 equal weighted is the blue line, which has underperformed. So most of the performance, the big performance, is really concentrated in those 7 companies. And the other thing that I think is an important takeaway for us is the magnitude to which the concentration has driven this effect, and just the magnitude of the market cap. If you compare the S&P 500 total market cap, compare that with the Magnificent 7, then the Magnificent 7, and then, for example, the Russell 2000 index as the concentration of all the small caps, we can clearly see here that a move in the top 7 companies in the market will have a very or should have a very significant impact on the rest of the market. For example, we see a reallocation from the Magnificent 7 into small caps. Just by the sheer magnitude, we should see a significant impact. That's basically what we're seeing here. That's basically what we saw about a month ago, and what we're seeing certain days in markets where we're seeing the mega caps underperforming and the small cap indices jumping up those single days. We need to see more evidence that fundamentals are strong for the small caps for that to continue. But we think it's important to keep in perspective the relative magnitudes of the sizes of the Magnificent 7 compared to everything else, especially the small caps. Then we also do the same with valuation. So here looks a little funny here, but it's so that we keep the same scale on both charts. The one on the left is the S&P 500 as a whole, 21.6 times forward PE, as we saw, and the Magnificent 7, 35.5 times PE. So again, a lot of the higher valuations that we're seeing is driven by these this very concentrated part of the market of the 7 largest companies in the US. Both price to earnings and ROE. Another important thing to note here: ROE is the ultimate driver of valuations and performance. So basically, for a higher return on equity, there will typically be a higher price to earnings multiple that goes along with that higher profitability, the higher compounding effect over time on capital. And here we clearly see that effect, right? So the Magnificent 7, 53.6% ROE, very high, very highly profitable group of companies, accompanied by these high multiples. So I think what's important, the key takeaway here is, yes, markets are expensive, but also from a valuation point of view, but also the fundamentals are strong and are trending higher, and so that could justify this kind of price performance for longer if this profitability trend continues. Then we go into the other parts of the markets, comparing the US with other developed economies. Here we see some of the European economies, along with Japan and Canada, the UK, and some asset price movements across different market segments, from emerging markets to different regions, Europe, the MSCI world as a whole, the Nikkei index, etc. And then we also have bottom side of the chart, the REITs, the real estate, oil, other commodities. Overall, I think it's been a stronger than expected market this year, at least from what expectations were at the beginning of the year. A lot of that has been driven by the inflation dynamics, inflation coming under control, a lot closer to the 2% long-term target after the very aggressive monetary policy that we saw over the last couple of years. Now we're seeing the easing, the beginning of the easing cycle. In the case of Japan, very important to note that we're seeing a normalization of the economy, healthier inflation levels there, and that also, with I think a positive read in terms of the longer term fundamentals for the Japanese economy and corporate earnings there. In Canada, we have a very similar situation as in the US, inflation coming down after a very aggressive monetary policy tightening cycle. US the same. And basically what we're seeing across the board, here we're showing the 20 largest economies in the world, is this normalization from very high inflation with a very aggressive response from central banks across the globe, now bringing inflation back down. And we see that also expressed in terms of the flattening of the yield curves across the different economies, in this case for the G7, but also across the 20 largest economies, which include some of the larger EM economies. The US economy doing well, still strong growth. If we all remember, about a year ago, 2 years ago, there was this fear of a significant recession. Hasn't materialized. We're not seeing any evidence of that. Corporate earnings are certainly very strong. And then if we compare with other economies, we see also on a relative basis stronger economies across the globe. Currencies, I think here there's going to be a lot more variability depending on relative inflations across the globe and relative interest rates and monetary policies across the different central banks. Some of the EM currencies with showing the worst performance here: the Brazilian real, Turkish lira, Mexican peso, as well as Argentina. On the other end, we have the South African rand, and some other currencies showing strength relative to the US dollar, but definitely the ones with the greatest negative magnitude: Argentina and Mexico. The US economy, as I mentioned, showing very, very healthy fundamentals. Consumer confidence, initial claims at very adequate levels, inflation coming down, GDP growth still growing at a brisk pace. And with that as context, what we wanted to review, this is very important for us for our international strategy, relative valuations. So we saw at first the S&P 500 valuations. Here we're showing Japan, MSCI Europe, MSCI World ex-US, and emerging markets. And in all cases, what we're seeing here, when comparing with the S&P 500, basically all markets across the globe are cheaper and have trended down in terms of the discount to the US market, or the US market has expanded its premium. So generating very interesting conditions to evaluate potential diversification away from the US with attractive valuations. We look at Canada, Australia, the UK, and the Nordics. Similar trend. Virtually in all cases, we're seeing valuations, valuation spreads closer or at the one standard deviation below the 20-year average. So it's a very dramatic um, expansion in terms of the premium that the US equity market presents today, and by the same token, the cheapness that these other markets are presenting today. Now we go back to the fundamentals. Again, the US market, I think to some extent justified, given the strength in earnings growth, as well as we'll see in a couple of slides in terms of return on equity. MSCI World also trending higher in terms of the expected growth, from single digits, low single digits, to now above 10%, above the historical average, but definitely trailing the strength in earnings growth compared to the US. Then if we look at the expected growth, very similar, 14% basically compared to 12.2%. So there we see a couple percentage points premium for the US market compared to the MSCI World Index. So yes, the US is showing higher earnings growth, more strength in corporate earnings, but not to the extent that the valuation spreads would suggest. So that's another key takeaway for us. International markets look attractive on a relative basis. They're not as strong in terms of earnings growth and ROE as the US, but they're still strong, and the valuation gap is so big that we think there's an interesting opportunity there for international markets right now. Over the next couple of slides, what we're going to review is the basically what is known as the Fed stock valuation model. It's basically a comparison between where the fixed income yield is compared to the equity yield, and what that says in terms of relative valuations. So first of all, to set where the fixed income 10-year notes, in this case we're using the US 10-year notes, compared to inflation, we're basically where we should be. It's probably a little bit ahead of the curve now, as we can see on the right hand side of the chart. So a lot better in terms of the outlook compared to a year or 2 years ago. Basically, after all the work that the Federal Reserve has done in terms of tightening, and also that final part of the curve, which is above the 20-year average, which is a red dotted line. Well, that means that basically we're a little bit ahead of the curve compared to where the spread should be compared to the 20-year average. Now, the second step of this analysis is, okay, how does that compare the 10-year note yield compare with the earnings yield for the equity part? In this case, we're using the S&P 500 yield, which today is 4.6%, and then we compare that as a spread. So the difference between, or the premium that you should be paid on the equity side above the fixed income side, and that's what we have on the right hand side. The historical spread has been 3.5%. Right now is 0.8%. So this is another way of evaluating relative cheapness or expensiveness of a market. In this case, we are at a 20-year high. Basically, confirmation of what we saw in slide number 2. These next charts, what they show is for a given level of yield for the 10-year note, and for the given level of expected growth in earnings, which, as we saw, it's close to 14% for the US, 12.2% for MSCI World. If we only moved price, what would be the price action needed in order to bring this chart, the one on the right, to the historical average? And that's what this says. This says that we need a 37 price correction in the S&P 500 to bring that back to the historical levels, 32% in the case of the MSCI World. So this is definitely spooky information, spooky analysis. but again, we need to keep this in perspective, based on the fundamentals, based on the earnings growth, based on the profitability of the companies, particularly looking at return on equity. What we do in the next few slides is a dispersion analysis, and with very simple regressions for any given fundamental point as a starting point, what is the expected return based on the historical data set. So we start with a P ratio. The current level of 21.6% would imply a 10% return for the next 12 months. In the case of the ROE, here we can see what I've been mentioning. The ROE is clearly trending higher in the case of the US, from an average of around 16% to levels that are higher or above 22% on average for the whole market. If we use that as a starting point, here we see a negative a return, negative 2.5%. If we start with expected growth and do the same analysis, we get expected returns between 11 and 8% for market conditions as of today for the next 12 months. And if we look at an MSCI World ex-US, we're looking at a 3.8% expected return with a current starting point of 14.2 times forward price to earnings. Same exercise in terms of ROE. Here, again, if we compare the 22 or 23% ROE in the US, the MSCI World ex-US is actually closer to 13%, 12%, 12.3%. And then the same for the EPS, and here we're seeing this much lower expected return of a single digit to negative 1.5%. MSCI Europe, 13.7 times PE, expected return 3.8. MSCI Europe, 14% ROE, 2.8 expected return. So what we can see here is across the different markets for the different regions, the different segmentations that we're doing, we're looking at single digit returns based on the current starting point, and that's very consistent across the different sectors. We did the same for the Nordics, for the UK. And basically that's what we're seeing. We're seeing single digit expected returns. So the key takeaway here is this is the perfect market for stock selection. This is where conditions, we think, based on our experience, this is where a manager that has the ability to look for interesting specific companies can make a difference and can make attractive returns. And then the final slide here, we have two proprietary indices. One is the Selective Aztlan Mid Cap Index, which is up 29% since inception, cumulative, 6 percentage points ahead of the MSCI World Mid Cap Index. Year to date, up 14.92%. These data points are as of the end of last month. And the other index that we have is the Aztlan North American Reshoring Index, which has had a difficult year, this 2024, up 2.58%. That's of the end of September. And whereas the S&P 500 was 22% up year to date as of the end of September. Overall, we think the market is more tilted to the positive side. However, the yield curve inversion, the relative yield spreads, equity versus treasuries, as we saw, are still major negatives. I think the big positive is what we're seeing here in terms of the trend of the fundamentals: higher earnings growth, high return on equity overall. So that's the monthly market view. The other report that I wanted to show, if you give me 1 second, was the Aztlan country, the Aztlan quant model allocations. I think it's an interesting view. let me put here on screen this other report. Here it is. And just very quickly go over the model and where we are as of the close of September 2024. So the first slide here is for the mid-cap model factor returns. What we're seeing here is the global indices first: world, SMID, US, Europe, and Japan. Just the overall return year to date. And then what we're seeing is for the different factors that we use in our model: cash flow, value, return on equity, growth, earnings revisions, momentum, and estimates for price. Also liquidity, how these different factors have performed for this year. So definitely dividend yield, free cash flow yield have had a strong year, as well as the earnings yield, or the inverse of the price to earnings, so value, followed by ROE and earnings per share growth, as well as the momentum factor. I think revisions and earnings surprise have been less successful this year, if we can say that. But across the board, all the different factors that are part of our quant model that we use in our process are showing positive returns year to date. Now, what we do here, the way the model works is we rank the entire investable universe. In the case of this mid-cap, it's 45,000 securities that we consider. And what we do is we apply all these different factors in a combined single model, and we rank all these securities, or all these stocks, from top to bottom. The highest would have the highest free cash flow yield, the highest ROE, cheapest valuations, etc., the whole combination, and from top to down. And then what we do is we aggregate first by region and then by sector from the bottom up, and with that kind of construction we get this chart, which is very interesting and gives us the indication of where the model is going in terms of regional allocation. So what we're seeing here is a clear reduction in the exposure to North America. NAM is North America, that's the blue bar, followed by Europe, which is the yellow bar, and then Asia in this case, and New Zealand, Japan. So about a year ago, we started seeing this very significant expansion into Japan by reducing North America. So that's one key thing that we're seeing in terms of our allocations. Here's a 3-month moving average smoothed view of where the model is going. So clearly here we can also validate that North America is showing this significant reduction in suggested allocations, and going strongly into Europe and Asia, Japan primarily. In the case of the sectors, same situation, same kind of construction. Here I think the interesting piece is financials, right? The financials is really expanding from the second quarter of this year. And basically here the model is capturing, we think, the effect from monetary policy across the globe, financials being the first beneficiaries of these effects. But we also have strong allocations in consumer discretionary and industrials. Same view here by sector. What are the changes on a 3-month moving average, smoothed average? Financials again, the largest in terms of addition to the allocation, followed by energy and consumer discretionary. Everything at the expense of tech, healthcare, and real estate. And then we do the same for the large cap sector globally. What's been the return for each of the regions in the world? and then the returns for each of the factors: cash flow, value, return on equity, etc. Again, here we see very strong returns, stronger than the mid-cap segment. And in terms of the region allocations, interesting here, all last year we saw this expansion into North America, and now from June of this year up till now, a reduction in this allocation to North America. And really here Europe is what is taking the larger allocations more recently. Here we see the changes by region: North America, Europe, and Asia. And now by sectors. And sectors here, I think we see a similar situation, stable in terms of the financials. It's the largest sector, but it's remaining stable. Here what we're seeing is a reduction in materials, some of the more cyclical sectors, and seeing industrial and consumer discretionary more stable. These are the changes by sector on a 3-month basis, and with that we finalize the presentation for today.